Next, we have not just the retirement optimizer, but the entrepreneurial investor. So we're specifically talking business owners, real estate investors, people that are seeking opportunities to invest in XYZ sort of an investment. And these are for folks who are, like, think about the folks who are, again, looking for those opportunities. They may need it for their business to reinvest back into their business. They may need it for emergencies that may come up within business or otherwise. And so the entrepreneurial investor type of person is one who's like prefers liquidity and control over their capital no matter what, right? That's what they prefer because they know that they can go create a greater rate of return and a more predictable rate of return than perhaps maybe the stock market or what have you can create for them, okay? Now, in order to create this liquidity or just kind of keep this liquidity, usually the entrepreneurial investor, they're storing their money in where everyone's pretty used to, perhaps bank accounts, because of the fact that they're highly liquid, they're very, very familiar to all of us, and they're viewed as safe places to store money, which, you know, I'm not going to refute that, although there's some arguments that can be made. I'll save that for another day. But I will say bank accounts can create some disadvantages though, because there's returns that happen within your bank account. But at the same time, those returns are not guaranteed. Those returns can change out of nowhere. The returns tend to be pretty low. And the reason that they can change a lot is because these rates that perhaps banks may give can oftentimes be based upon promotional rates from the Federal Reserve. It looks like we had another person join in, so I'm going to let her join in as well. I'll keep going for now, though. Let's see. But yeah, another thing about the bank accounts, though, that's can be a disadvantage oftentimes is simply the fact that there's interrupted compounding that's happening. And I think that can go significantly understated of like, if I can have X percent compounding and growing and compounding and growing and compounding and growing throughout the rest of my life without it ever being stunted with the growth, there's a huge value add there. And so that's not something that you get with bank accounts. And also, bank accounts, they're not built to pass on wealth at least not very efficiently. Whereas life insurance, not only are you building cash accumulation, cash value, but you have this death benefit that's been growing the entire time. And I'll show you that probably in a few minutes here, okay? So how high cash value, specifically life insurance, fits into the fold is that it's more efficient for long-term storage of capital for opportunity. The growth is going to be effectively tax-free, and your access to that capital is also tax-free. Now, you'll see a note in here that says cash value grows tax deferred. I put that in there as a technicality simply because of how the IRS sees it. But in terms of accessing the life insurance capital, you're able to utilize that tax-free every time. Also with this, there's uninterrupted compounding. So for those who are investors, they're going to go out and earn their 12%, their 15%, their 37%, their 200%, whatever it is in a sort of an investment. Usually, if you take it from a bank account, let's use an example. Let's say, for example, someone has $100,000 in a bank account, just as an example, but they're an investor and they see an opportunity. And that opportunity is going to cost them $20,000 to get into or something like that. Well, with a bank account, now you got to withdraw 20 grand to put into the investment. Nothing inherently wrong with that, but might there be a better way? With life insurance, how it works is you have, for example, $100,000 in cash value. You can actually borrow against your policy in the tune of $20,000. And what happens is your entire $100,000 in this example would continue to grow as if it were never touched. That's one of the powerful components that you get just by having a properly structured whole life insurance policy. When it comes to the legacy and leaving a legacy to your children's children and just kind of generational wealth, this is where life insurance shines the most. And in fact, that's why it was created from the very beginning, right? There's a guaranteed death benefit that's going to create an instant tax-free wealth transfer to your kids, grandkids, to church, or whomever that may be, because that's what it was designed to do, right? And you're going to leave a multiple to a large degree of what you've put into it, simply because we have actuarial science working on the side with life insurance. And last thing I'll say here is just the better long-term control. In other words, you're getting greater growth. You have access to more of it. You have control over it at any point in time, and way more protection than bank accounts tend to offer as well.